Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds in Melbourne, and this is a review of markets in November 23. Huge rally in bond markets over November after underperformance in September and October. But certainly the inflation narrative continues to vastly improve. Global commodity markets and global energy markets continue to dissipate. Oil's below $70 a barrel today. And the market's expectation for central bank policy pathways into early 24 is now for support and rate cuts, probably starting in Europe or New Zealand. This is really interesting because obviously as inflation continues to come down, we've now got interest rates in many jurisdictions that are highly restrictive. As inflation does continue to moderate, as rates are cut, that still can stay quite restrictive relatively. But no doubt it'll help financial markets build some kind of bridge to the other side. It is worth considering, though, if we are to experience a soft landing, as is widely expected by many financial commentators, that is still a landing in and of itself. We've been flying around at 40,000 feet. Everyone's enjoyed excess stimulus in terms of liquidity policy, fiscal policy, monetary policy. That's now been taken away. And as the aeroplane is stalling, thankfully, it doesn't look like we're going to have a nosedive straight into the ground hard landing. That's catastrophic. But a soft landing is still a vast moderation in terms of economic performance and asset performance that requires careful consideration. Clearly, at the moment, we're seeing weakening demand the world over. We've just had GDP data here in Australia, which is negative for the last 2 quarters on a per capita basis. The only thing that's holding up Australia at the moment is net migration. We're bringing in new participants, which causes issues in and of itself, certainly around housing in the inner cities of Melbourne and Sydney. But this is important to note. We are not going to accelerate as an economy from here without changing our policy settings. So we continue to lose momentum. That data was from the 3rd quarter of this year, and arguably the 4th quarter will be weaker again. So it is sensible for the markets to be considering that central bank policy is complete. I know that inflation in Australia has been stickier and higher than other jurisdictions, but we were very slow to come into that inflationary impulse. America breached 4%, that magic number for central banks, in April 2021. Australia didn't breach 4% until January 2022. So some 9-month lag. And we're seeing that lag also on the other side as inflation's coming down. Now, obviously, the rise of rates on Cup Day in November was a little bit of a loss of patience with how long that is taking. But certainly the fall in commodity and energy markets will help that process considerably. And as we're seeing in Europe, which has essentially got no inflation at the moment, the US, which is moderated right down into the low 3s, China, which is negative, then it's very likely that the Australian story will follow other jurisdictions and we will get back towards those targeted mandates. That's a good news story for rate cut expectations. Certainly, as we said, we believe that Europe will be the first central bank to cut. The Fed has also got expectations for cuts next year, and we should expect that the RBA will get going. Certainly, by the middle of the year or certainly into the 3rd quarter is probably our base expectation here at the moment. Bonds should continue to do very well in this environment. Clearly, that now that inflation has certainly moderated considerably and there can be more support coming, it should be a very constructive environment. As we saw in November, global bonds had their best performance since the mid-1990s on a monthly basis. So really extraordinary turnarounds from worrying about a number of issues prior to that, primarily around the sustainability of US debt. As we can see, if we've got a friendly Fed or a Fed that can help cradle, the performance of those assets, then we can still issue a lot of bonds and bonds can perform just fine. So the issuance story it's a story that's worth something, but it's not the whole story. And certainly, with inflation moderating and economies cooling, we do expect that the bonds can continue to go on and have a very, very successful 2024. We look forward to speaking to you about the macro over that time frame, and certainly wish everybody a wonderful period, a Christmas and holiday period coming up. It's obviously been a fairly volatile and choppy year in many asset classes. We're going to finish off the year with some reasonable performance in bond markets. which we believe is that kind of secular turn that after the period of rising rates, clearly 2022 was a very difficult year. We saw the early signs of that turn in 21, now turning the other way. We do expect that 24 will be a really good year to be invested in fixed income, high quality fixed income at that. Thank you very much.